Welcome to today's market report. European stocks closed lower on Friday, down more than 1% this week, as investors weighed risks from tighter monetary policies after the ECB signaled a slowdown of pandemic-era bond purchases. The Pan-European Stock 600 index fell 0.3% and declined for 4 of the 5 sessions this week, as worries persisted about a slowing global economic recovery. Still, defensive sectors such as healthcare and retail estate notched the biggest weekly declines as investors positioned for a possible pickup in economic growth. News of a call between Chinese leader Xi Jinping and US President Joe Biden offered some relief to batter Asian stocks, particularly tech companies that have come under heightened regulatory scrutiny in Beijing. Tech stocks in Europe rose 0.7%, while luxury stocks got a boost as France's LVMH rose 0.8% after HSBC recommended buying the stock. China-exposed miners were the biggest gainers on the day, up 1.1%. European stocks found support after the ECB stressed it was not about to close the money taps despite projecting higher growth and inflation for the Eurozone. The outcome of the meeting is likely to be supportive in the short term, according to UniCredit. But even if ECB President Christine Lagarde was cautious in highlighting that the decision was just a recalibration, a real tapering is probably coming next year, provided that economic conditions remain good enough. European shares have hovered below their mid-August record highs on the back of strong earnings and recovery prospects, but major money houses are skeptical of further gains, particularly in US stock markets that is home to high-growth companies. Data showed Britain's economy unexpectedly slowed to a crawl in July as the Delta variant of COVID-19 spread rapidly. Oil rose to briefly top $73 a barrel on Friday, supported by growing signs of supply tightness in the US as a result of Hurricane Ida, and the US-China trade hopes gave riskier assets a boost. Brent crude rose to settle at $72.92 per barrel. WTI crude rose 2.3% to $69.72 per barrel. Both grades posted a small gain on the week. Brent has rallied 41% this year on supply cuts by the organizations of the petroleum exporting countries and some demand recovery from the pandemic. Gold futures was down 0.6% at $1,789.20 per ounce. On the FX front, the GBP/USD peaked on Friday at 138.87, the highest level in a week, and then lost momentum. Near the end of the week, it is trading at 138.40, around the same level it had a week ago after erasing daily gains. The greenback strengthened late on Friday amid higher US yields and some risk aversion. The US 10-year yield rose to 1.35% after opening the day around 1.30%. Economic data from the US showed higher than expected PPI inflation in August. Next week's US reports will be relevant. Retail sales will give more information on how much goods consumption is slowing as the effect of the stimulus checks fade. Very strong US goods consumption is a key driver behind the global manufacturing, overheating the pressure on global freight. US CPI inflation and regional business surveys will also be very interesting. Euro-dollar looks to stabilize just above weekly lows in the 118 neighborhood and recedes part of the earlier advance to the mid-118s or 3-day highs. Looking at the daily chart, the short-term resistance line around 118.80 is expected to keep limiting the bullish attempts in spot. The mild recovery in the dollar comes in response to the mild bounce in yields of the US 10-year note to levels above 1.32%. Hawkish FOMC member Mester suggested that inflation would remain high this year, just to edge lower in 2022. German final inflation figures showed the headline CPI came in flat on a monthly basis in August and rose 3.9% from a year earlier. Inflation tracked by the broader HICP rose 0.1% month-on-month and 3.4% year-on-year. The dollar index gained 0.05% to 92.57.
This is today's market news. Thanks for listening. We'll see you next time.